Great. Thank you very much, Marissa. We appreciate the introduction. So I want to just make sure we're advancing. There we are, introduction. So again, this is Rob Benuelos. I am the Senior Managing Director at HSA Bank. I oversee sales from the sales organization, and really happy to be participating in the reporting of some of the survey findings. We're also excited and do want to thank the Plan Sponsor Council of America for working with HSA Bank and allowing us to be one of your sponsors for this particular survey. We know you've done it for a number of years with great results. So presenting with me today is my colleague, Luis Dofo. He's our Managing Director here at HSA Bank, oversees our large market or national accounts. So we will conduct the survey and really touch upon some of the high notes of the findings. And then again, please submit questions as you have them, and we'll address those as they come up. So let me give you a little more background on the overview of what the survey consisted. The survey received, we took responses from 464 organizations that offered HSA programs to their employees. The respondent of these companies represented a large range of various industries and employee sizes. There was a particularly large increase in the number of respondents that came from smaller companies. If you look at the chart there, you can see we had really high increases in the number of responses, but the high percentages really attributed to those smaller employers in the 1,000 and below rankings. This was a really important shift, and it's important to keep that in mind when considering any of the changes in the data from the last year. One of the things, though, I want to call out, and this could be misleading, so if you look at the percentages for the large employers, so 1,000 and above, don't be misled, because if you really look at the actual findings of how many large employers responded, there were about roughly 92 large employers that were 1,000 above in 2022 compared to the previous year of 70 employers. So we still got a great sampling of large employers, even though we had more respondents that were coming from the small employer groups. Now, what we also found here is more than a third of the employers have an HSA qualifying health option to their employees, and those, about a third of those, had the HSA in place for 2 to 5 years. Another third of these individuals or these employers have had the HSA plan in place for the last 6 to 10 years. So we really had a really advanced and mature population. Let's focus here on some of the data highlights. As you can see here, some of the data highlights, we have an average participant contribution in 2021, almost $3,000. So this was slightly down from previous years. But nonetheless, when you compare that to the overall industry and when you compare it to the average book of business here at HSA Bank, pretty much in line. This is kind of what we see here at HSA Bank. If you look at the other finding with respect to the average account balance at the end of 2021, that was a little less than $4,300. So that was slightly down from 2020, which is at about $6,300. You know, I think one of the things you can attribute that to is the pandemic. I think that had a lot to do with the average account balances. Folks were really concentrating on what was going on in the environment with the pandemic, and I think they were watching their dollars a lot closer. Therefore, I think it impacted the overall average account balances. 3/4 of the employers are making HSA contributions. This has been pretty consistent throughout the industry and really aligns exactly with what we see here at HSA Bank. I think that's going to be a trend that we continue to see. Greater than 20% of the participants here are investing as compared in 2021 and accounting for almost 30% of all the assets. Now, this tends to be a little higher than I think what we see in the industry and even what we see at HSA Bank. And I think we'll address some of those highlights in just a bit, but I think from an asset standpoint, that's pretty consistent. The total assets, when you look at those balances, running at about 30% of the total assets are in the investment component.
Yeah, Rob, I think another thing to note on these average participation numbers, contributions as well as balance is, again, in your previous data highlights, you mentioned that our pool of respondents to the survey was increased, almost doubled, but it was smaller accounts. And one of the unique things to always keep in mind in our presentation today is while the numbers across the board did go down from a contribution perspective, as well as a average account balance, again, let's make sure it's all relative for everyone that's participating on this call, and let you know that as the pool increases, the number of smaller accounts, so the overall average kind of declines. But we did see a decline just across the industry overall.
Yeah, that's a great point to highlight. Absolutely. And again, going back to pandemic, I think that was pretty consistent. It was not just unique to this survey or unique to HSA Bank, but I think overall. But I think now we're beyond that. I think we'll continue to see positive trends, and we'll see that continued growth in a positive way. Let's look at some of the data highlights with respect to administration. So one of the things that we saw here is that nearly 70% of the respondents here indicated that the employee education is of top concern. So that was half of the respondents indicating that that was their primary concern, but that was also a common trend that we saw as a second priority. I think this is something that we've heard consistently. Now, this represents a challenge for employers, but it also presents a really nice opportunity for administrators and partners working with their employer groups. Here's some low-hanging fruit that we're going to talk about in just a bit. Again, education, and really when we talk about education, we also view that as the engagement component, because engaging with employees, whether it's educating them on the benefits of an HSA or engaging them to be active with respect to their health or wealth, very positive aspects to the education component. More than 40% of the organizations are automatically enrolling their employees in an HSA if they enroll in the high deductible plan. I think that's a very positive trend. It makes sense for employers. Send us your census. We'll open up those accounts. We'll go through all the appropriate consumer identification program checks to have those accounts established. And this really takes the onus off the employees from having to take any action to open those accounts. So we think that that's going to be a trend that will continue. Today it's over 40%, but we think more and more employers will continue to do that. Fewer than 30% of the employers have positioned their HSA as a retirement savings vehicle. Now, this may be surprising to many of you out there because I think most of us do understand that the HSA is yet another retirement savings vehicle, and dollars that we can use in retirement towards medical expenses and other associated costs that we're going to need in retirement, especially with the projected expenses that you will incur once you reach age 85 and beyond. So I think this is an interesting stat. I think it creates yet another opportunity with respect to education and engagement. And we're going to talk about some of the things that we see out there in the industry and also within HSA Bank. More than half of the organizations are covering HSA administration fees. That's pretty common. The fees are generally assessed. We're looking at anywhere from $3 per month for a participant on an average. We've seen in the last few years that number starting to decline with more volume. This certainly the administration fee gets commoditized. I think that's another trend that we'll continue to see, but most of the organizations do take that on as a responsibility to pay for those fees.
Yeah, a quick question for you, Rob. Is that the case in the public and private sector, or is the public sector still kind of pushing on those fees to their employees as well, like state, municipalities, and whatnot?
Yeah, that's an interesting call out. And that wasn't one of the data points that we looked at in the survey. But yes, to answer your question, we do see that more of the public sector does want to pass on that fee onto their employees. In the private sector, they take the responsibility. They're offering that as a potential plan offering. The employers do recognize that that comes typically with a lower premium cost. So there's an advantage there to the employer and to the employee. So therefore, it makes sense for them to pick up the tab on those. I think we'll start to see that trend for the public sector also in time.
Excellent.
Great. So now let's look at some additional highlights here with respect to employee contributions. This was an interesting area. And Luis, why don't we call out some of these areas that you identified throughout the survey?
Yeah, well, I think one of the questions that we all hear as administrators, right, from our employer group clients or potential clients is, if I pay for the administrative fees, if I invest in education and additional resources to engage my employees, will they not only open the accounts, but more importantly, will they take advantage of these accounts and contribute into them? And I think this survey, as well as the surveys that are thrown throughout the marketplace, consistently support that idea. If you put it in place, the employees will come, they will contribute, and we can see it from these stats here. The enrollment numbers continue to stay steady in the 85 and above range, but what's most important here is percentage of employees with an HSA who actually contributed to it are still above 70%. Now, of course, we see a drop here in 2020, 2021. As Rob mentioned, most likely it was due not only to the pandemic and individuals having to reallocate funds to cover their costs. Maybe they lost coverage for whatever reason. But another thing to note, again, is the pool of respondents to the survey. Again, we had a lot more smaller employer sizes, and they're all looking for opportunities to take advantage, but the contribution amounts sometimes may be smaller than expected if there's no seeding, if there's no incentive to really participate.
Yeah, that's an interesting call out. So, there has to be some strategies out there that are being approached by employers because, especially if employers are funding some of these programs to maybe provide an incentive, they also want their employees to take full advantage of it. And maybe a component of that is the education, not fully understanding all of the tax advantages to that. But I think that's a challenge that employers are seeing. They want their employees to also put skin in the game. So I know that there's some strategies that we've seen out there with respect to getting employees to put in their own money. Again, it's on a pre-tax basis. They can do it through their payroll elections, and it's really pretty easy and pretty simplified. It's just getting folks to take that first step to do that.
You're spot on, Rob. And actually, let's look at a couple of active enrollment incentives that we've seen put in place. Again, it's not always monetary. Monetary helps, and we'll get to that a little bit later in the presentation. But of the many different types of strategies being utilized today, I think the three that we're seeing most utilized actually begins with wellness incentives. Wellness has really taken kind of charge front and center over the past, I would say, 7 years or so. We've all seen it in conferences that we've attended, surveys that we responded to. And wellness can be as simple as, if you complete A, we will contribute B into your HSA account. Things as easy as complete a biometric screening, a health assessment online. A lot of companies have incentivized their employees to maybe take meetings during a walk so they get some exercise, but they stay active. Right? They stay proactive in addressing preventive health initiatives that the company always appreciates. I think the other one is decision support. This all started obviously with calculators, but now it's evolved into a number of other resources. There's a number of carriers that actually provide access to a little bit more in-depth decision support tools, maybe not tied to the specific medical plan and that decision you make, but more about, here's some planning tools that you can utilize to make sure that plan A is the right fit versus plan B. And that obviously dovetails into whether the HSA is better aligned for you versus the traditional flexible spending account or maybe an HRA that's being offered. There are decision support tools out there that a lot of organizations, employers, as well as benefit administrators are offering up to the employees that actually ties the medical claims into the decision support vehicle and that final support that the employees are looking for. Now, of course, we saw at the very beginning of the survey results, education is a resounding theme that you're going to continue to hear throughout this presentation. And education continues to be presented as a differentiator, I know by us as an administrator, but by many others as well. And it's something that employers are really looking for as well. Would you agree, Rob?
Yeah, I mean, those are really excellent call outs. And I know that there's a lot of other active enrollment strategies out there. I know you just keyed in on kind of the top 3 that we see out there. And that was a really good recap. I know on the wellness activities, absolutely makes sense for a lot of employers. And again, this may be an opportunity where employers are using where they traditionally have been funding the accounts all on their own. Folks have gotten used to that. It's easy. Your employer puts the money in. Now employers are looking to their employees like, earn those contributions. And that could very well be in the way of a wellness activity, just like you mentioned. So I think that's a perfect strategy. Again, it's now pulling those employees in to get more engaged and now own their health and own their wealth. So absolutely, those are great top trends that we're seeing with the industry. And I like the one that decision support, it's getting employees to do the math, figure the math out. Because again, as I mentioned earlier, the employer takes a huge advantage with these high deductible plans because they are typically lower premiums. But again, it's a win-win for the employees. And if you get folks engaged and they start doing the math through these decision support tools, very easy, simple, black and white, they will be able to see the advantages, and they're huge. So, you know, it'd be interesting to see what our attendees have to say about some of these.
Yeah. Well, why don't we take a poll? Do a quick pause here and have a poll question come up so that you all can tell us, what you're looking at, what you're seeing, and what you're potentially considering for the near future. So we'll just take a couple moments to give you an opportunity of answering, are you doing wellness activities or looking into wellness activities for the future to create active engagement? Or is it decision support? Or is it just more of an investment and a partnership to provide more educational resources?
Well, great results. Yeah, this is really interesting. This is only 75% of the attendees that responded, but clearly, no surprise here. We keep hammering on this one about the educational resources. Again, it's a huge challenge for all employers, regardless of what size, whether it's a small employer, mid-size, or large employer. Year after year, we continue to hear this. Again, huge challenge, but great opportunity for many employers. So no surprise there. I think we're gonna take some more time later in the presentation to talk about what we can do with respect to educational resources, because it is an important one. The wellness activities was second here. Again, no surprise there. Popular trend. We're going to continue to see more and more of this. We hear it. I know Luis and I, in discussions with some of our clients or prospective clients, this is one that's always being asked. They're trying to get creative. They're working with their various consultants or brokers, trying to get new ideas and be creative on getting their folks engaged and getting them more active from a wellness standpoint. And then decision support, again, very popular there. It certainly has a high percentage rating. We'll continue to see that more and more. Provide the tools, do the math. So good findings here.
Rob, would you say that on decision support across our total book of business, right, and even having conversations with consultant partners, they are looking for more of that claims integration within a decision support tool so that the employee really has that support? And part two of that question, are they looking for more of an AI type of system where it's self-service, or do they still need kind of that live individual to connect with and kind of walk them through the decision?
Yeah, so I think you highlighted a lot of options there with respect to decision support. And you're right. If you have your basic model of a decision support, typically that is just self-reported by the employee. It's essentially answering a number of questions. Then their responses will deliver a result and provide some guidance, right? So very high level, again, individually inputted information. If you want to start to ramp up the results on that, yes, absolutely. Bringing in claims data, looking at historical data, not just for a year, 2 years, but beyond that. So absolutely, that's going to give you a finer direction, more details, better guidance on the appropriate plans. And I think this really provides a level of confidence. When people use this decision support, now we can provide some confidence that when they make that decision, it could be a scary thing picking a high deductible plan, especially when you have to pay out of pocket for the first $3,500, $4,000. It's a big decision and it can be scary. But with these decision supports, it gives participants a level of confidence to make that decision and move forward. Great. Let's move on to employer contributions. So here's some of the findings here. So we saw that 3/4 of the employers contribute to the HSA, and of those, 60% provide a set dollar amount on the coverage. So we typically, it's $1 amount. Again, this is where the employer is putting skin in the game, trying to incentivize their employees to potentially sign up for a high deductible plan. Only 8.9% offer a match. So this is a really interesting one that we're going to really spend a little more time on. It can be complex, and so we've already identified that education is a huge challenge. So now when you start talking about an approach like a match to the employee's contribution, now it gets a little more complex. So you can see the percentage there. Some employers are doing it. There's a lot of employers that are talking about it, discussing it, evaluating it, but it is not really on the forefront for many employers. But I think this is something that we need to keep our eye on.
So Rob, on the set dollar amount per employee, right? That's something that's been going on for a while. Have the average contributions amount or set dollar amounts increased over the years? Would you say that they stay pretty much the same between $300 for single and about $600 for family? Anything that you've seen?
Yeah, I think we've seen those amounts pretty consistent. Now they have increased over the last several years, but not huge jumps. They've stayed consistent. And again, the set dollar amounts, it may be one set dollar amount for all employees, and then some employers may want to look at setting the dollar amount on the coverage level. So, for example, a single plan would get a fixed dollar. A single plus one may get an additional contribution, and then of course the family level would get a higher contribution. So we've seen those. I think those have been out there for quite a bit. And you can see by the survey, 60% are using that set dollar amount at the coverage level. But again, other approaches to making contributions are highlighted there. Some that are less popular than the two I just highlighted. But again, I want to make sure we probably spend a little more time on that employer's match contribution.
Yep. Excellent. Well, this is kind of a new strategy that we've been seeing, and as budgets continue to tighten up, the cost of healthcare, regardless of whether it's traditional PPO plan or even a high deductible health plan, they continue to increase. The matching contribution strategy is actually one that benefits a number of different individuals, not just the employee themselves, but it actually benefits HR teams because it allows them to go to leadership, especially their CFO partners, and say, here's a unique strategy where we can not only incentivize individuals to join the high deductible health plan with the HSA, but we can make sure that the incentives that we are providing them in the form of dollars, they also have skin in the game, right? It's not us just giving money on day one and saying, here you go, and then risking employees leaving or risking a decline in them taking care of their own health. So on the next slide, I think we're going to highlight what has been the more traditional process. We have an example here of 500 employees. Again, average plan where 250 employees themselves are enrolling in a single coverage on the high deductible health plan, and the employer decides to contribute $500, whereas we have another 50% of the population enrolled in a single plus one or family plan, so they can take advantage of a $1,000 contribution. Overall, if we get 100% participation, right, it costs the company $375,000 in contributions that it needs to allocate. At the beginning of HSAs, since it was so new, this was typically given right after open enrollment when the plan went live on its effective date, maybe 30 days later. The $375,000 was immediately deposited because it was there to support that deductible, right? That scary deductible, Rob, that you mentioned, that a lot of people, even today, still hesitate before selecting that option. What if something were to happen? How am I going to cover that deductible cost for myself, or if I have a family, for my dependents? Well, the matching strategy really takes into account what 401k has done and applies it to HSAs. So you take a portion of that dollar amount, the $375, and you provide a initial contribution. Here in this example, we have $200 for single, $400 for single plus one or family. Now, that is a set amount that's not tied to anything more than participating in the high deductible health plan. Now, the match comes into effect for every dollar that the employee puts in. They can get an additional dollar, up to $300 in this example for single, up to $600 if it's a single plus one or family. But before I go any further, the $200 and the $400, there's some unique strategies that we're seeing in the marketplace around that, right, Rob? Is it still given up front, or are employers kind of holding back a little bit of it?
Yeah, good call out. I think employers are trying to be mindful as they approach this type of contribution strategy. I mean, it's an effective one, but they're also concerned that employers or employees may leave throughout the year. So they can certainly take a proactive approach to protect themselves, that maybe they don't provide all of the upfront contributions in the first month or the first quarter, and then divvy it out throughout the year. They're concerned about the Great Resignation, right? So we saw a lot of that through pandemic. Employers are now getting folks back to work, trying to figure out, are we going to be remote? Are we going to be hybrid? Are we going to rehire the people that we had to lay off? They're trying to find their sweet spot. So there is something we've heard about, the Great Resignation. So this is a way for employers to really protect themselves, maybe not give that seeding money all up front, but rather maybe on a monthly basis or on a quarterly basis.
Yeah, no, great point. And I think that also reduces some of the concerns, but more importantly, on paper, some of the liability, right, from the company's perspective, from the CFO that is constantly looking at those dollars and cents, and making sure that they're being utilized and allocated based on the strategy that our HR partners are presenting to them, right, when they go get that business approved. So coming back to the example, right, if we look at these numbers and we do the math, as you mentioned earlier, Rob, right, we have $150 of seeding. The match, if we get 100 participation, $225,000. Now, there are payroll and tax savings that the company could take advantage of. And at the end of the day, we've actually created an incentive plan. We reduced the amount that we initially wanted, but more importantly, we are inviting the employee to participate in the overall strategy, right? But what this also does is, while we've decreased the initial total amount that we would seed, this is where we can work with our CFO partners and say, let's implement this strategy. If it works, right, I think that's more than enough to convince you to continue to increase, right, those contributions, that seeding that we want to do in year 2 and year 3. Especially if you're a first-year HSA programs, right? One of the things that concerns everybody across the board is, what is that adoption going to look like, right? And adoption is based on how much you invest as a company, not just in dollars, but in dollars, in education, in resources, in evangelizing the plan and building on it year after year. Would you agree with that, Rob?
Absolutely. I mean, I really am excited about this strategy, and I really think that we're going to see some adoption here in the next few years, because it does make sense. And you take into account when these health plan decisions are being made within HR, more and more we're seeing the directors of finance, even CFO, involved in those decisions. And this is a perfect example. If those folks see this, boy, their eyes light up. Their eyes light up because it impacts the bottom line. And while this example shows $22,500, maybe that doesn't seem a lot, but if you're a pretty large employer, those numbers could really add up. And if you have a lean HR department, guess what? That could fund potentially another FTE. So really, there are big savings there. And again, it's a win-win. The employer will win, employee also wins. And we have seen that with these strategies, when they're implemented, employees tend to max out and put in more into their HSA, which is what we want. We want those folks to be prepared and have full retirement readiness when it comes to expenses.
So I'm sure one of the concerns that is always brought up is around administration, right? So I'm wondering what the survey, really tells us with these stats regarding, the primary and secondary concerns, and more importantly, do they tie with what we're seeing within the industry, right? Conversations that we're directly having with employers, as well as conversations that we're having with our consultant partners, right? That are having these direct strategy conversations with employers.
Yep, absolutely. And again, we keep coming back to this, but the results are the results. Clearly, you can see we keep talking about employee education, primary concern, and yet a secondary concern. So top 2 boxes, this is among the most popular. Almost 70% call that out as a potential concern and as a challenge. So when you look at some of the other top categories there, compliance. So you think about the high deductible plan. You have to be in a qualified high deductible plan in order to have an HSA. Well, I think employers do a really good job to verify that they're offering a qualified high deductible plan, but there's also other ramifications that really the employee needs to look at. Remember, these are employee-owned accounts, so things that the employer may not know. So, for example, are there other plans that employee has that would be a disqualifying event? For example, you can't have TRICARE and have an HSA. You can't have Medicare and have an HSA. What about if you have a spouse that works at a different employer and may have an additional health plan like a flexible spending account? Those are all disqualifying events. So I think, employers identify that compliance is an issue, and that a lot of this may fall on the employee. So again, it ties back to that employee education, making sure that they understand that they're appropriately following the rules for having a qualified high deductible plan with an HSA. The difficulty in administration is another big concern. Employers don't want to own this. There's some things that are tied to the management of an HSA, and they're really looking to their partners to do all the administration with respect to communications, transactions, making sure that they're compliant, that they're staying within the annual maximum limits. Those are all things that the employer really looks to their provider to do. And then the last one I want to call out there, because it is important, it is a huge feature and advantage to the HSA, is that investment option. So I think even though it shows as a low concern there on the survey, I think what we've seen in the industry is we're starting to see that number creep up. And so when you look at the overall population of who actually invest with their HSA dollars, it's low today as an industry, but we continue to see that as a popular trend. More and more, we're starting to see that number grow. So I think that's an excellent area to really kind of focus in a little more on. We can advance there. So administration. So we'll come back to that investment component in just a bit. From an administration standpoint, boy, and this one, you know, being at HSA Bank and being a bank and an administrator, this one gets my eyes all glowy. So I was excited to see this within the survey. Top provider type from the survey, almost 60% identified that, you know, using a bank administrator is the best focus. So let's unpack why. So from my perspective, we talk about this all the time with prospective clients, and many of our clients at HSA Bank value the fact that we're not only the administrator but the bank. We have a lot of safeguards that we're held to as a financial institution. We come under certain regulations where we have to be audited on a regular basis. So you think about it from the employer's perspective. If they're putting a plan out there, they're starting to promote it, they're getting increase in adoption, they want to continue to drive more enrollment in that, the employer wants to feel good that there's some positive safeguards in there, not just with respect to protecting those assets, but also the transactions. So this one I was very happy to see, wasn't completely surprised, so I think that's a huge advantage, being a bank and the administrator. The next one is as an HSA administrator. So what does that really mean? So I think employers have identified that they really want best in class. So best in class, that if you're focused on HSAs and other healthcare account-based programs, that's your core competency. They want to go to someone that deals with that. They don't want someone that does everything from A to Z and then dabbles in HSAs. So I think this is the second most popular provider type. And then the next one that we see there, you see the numbers really drop off, right? So you got your banks, your HSA administrators, and then next would be investment firms. No surprise here that I think investment firms want to get into the business. They've identified this as a good opportunity for them to increase their assets, and they're promoting the whole financial wellness picture. But again, it goes back to employers wanting to work with someone that has best in class and has this as their only core competency. And if you're an investment firm that's focused on record keeping and 401k and all those other things, are you going to do HSAs as well as some of the others? So I think the percentages are low right there, but nonetheless, they're out there in the industry and they're another option for employer groups. Luis, anything else to add on that?
Yeah, I think this slide really calls. Oh, yep. We can go to the next slide.
Yeah, I think that plays well nicely with this. So yeah, the percentage of organizations that are offering investments. Right?
Yeah. So Rob, wouldn't you think that if you're looking to offer investments, that you would select a investment advisor or investment administrator to administer the HSA plan and kind of help you out that? Or is it more about, you know, what's really in it for that administrator at the end of the day?
Yep. Well, I think what we see on the HSA side, because investments are an important component, but very different from a 401k plan. There's it's run by the employer. There's a lot of provisions and guidance on how to invest. Here, we're really talking about individually owned accounts, self-directed accounts. So this really comes back to more of the employer, to trying to figure things out, doing their own research, doing their own sleuthing on what are the appropriate mutual funds or stocks that they want to invest. But we have certainly seen as a positive trend, you know, offering more investment solutions. We at HSA Bank have more than just one. So we have several. So, whether you're a first-time investor or whether you're one of those savvy investors, we offer those solutions to meet the needs. Here in the 401k lineup, so I know you have experience in this, so let's talk about your observations on folks matching up to a 401k lineup.
Yeah, I think, this one I'm sure catches a lot of people by surprise, because we consistently hear the theme of financial wellness, right? Tying in wealth and health together, and trying to make it as easy as possible for employees to invest for the long term. Yes, take the pre-tax contribution advantages that exist within an HSA, but then how do I take that money and really grow it exponentially, right? And I think one of the reasons that the results show what they do begins with what you said earlier, right? It's at the end of the day, self-directed account, right? Whether there's a managed portfolio in it, or whether it's a traditional, Schwab TD Ameritrade account or something else, it's still the employee going in and making that final decision of how they're going to rebalance their portfolio or what they're going to invest to. I think the other key thing to note is within a 401k, as many of our participants today know, there are specific funds that have been designated as retirement funds, mutual funds and whatnot. And therefore, they can't be translated or offered in the same manner as the HSA. I think the third reason is when you start really trying to match up the 401k, there could be the possibility that you convert your plan into an ERISA plan, right? Which is extremely scary. I think that's why, while a lot of employers love the idea of marrying up their 401k, I think their biggest concern is, am I offering diversification? Am I providing options and not overly confusing the employees? And I think that's why, at the very end there, you see 89.5% say that, nope, this is not a goal of mine, right? It's a pie in the sky goal, but if we didn't have all those other compliance unexpected items that could exist, right, that could trip me up, I think I'm fine where we're at.
Yep, I completely agree with you. You can't argue with the numbers there, that's for sure. So again, not many employers are looking to go in that direction.
But what should investors look for, or kind of getting back to that theme of education, what is the key to really understanding kind of that exponential growth that exists?
Yep. Well, again, I think the common theme there is that education component. So it's really important for account holders to understand that when they use an HSA, that it's to be used to pay for IRS qualified medical expenses. These funds really come with no tax implications if you use it for those qualified healthcare expenses. You're taking full advantage of it being a pre-tax dollars going in there, and now as you spend those for qualified healthcare expenses, no implication there. And quite honestly, I think some folks have actually kind of pulled back on spending the HSA for some of your basic expenses. They're paying out of pocket. They're saving those receipts because they know that they can cash them in later. And what they'd rather do is grow those balances. They want to grow those balances to get to a point where they can start investing. So when the account holders contribute into their HSA, they've reduced their taxable income, which we talked about. CFOs love that too. The HR department loves it because it lowers the overall payroll tax. And certainly as folks start to grow these accounts, we talked a lot about the investments, but by far that is the fastest way to experience compounded growth within your HSA. And that's pretty positive because as you start to have positive return on investments, those are also not going to be taxable. And again, if you play by the rules and you utilize your HSA account to pay for qualified healthcare expenses, all those dividends and all that growth with investment would not be taxed. So really a lot of positive attributes there. The other piece is, educating folks on the minimum balances that they need to keep in order to start investing. We see out there in the industry that thresholds are established. So thresholds make sense because we want folks to keep some monies in cash in order to pay for unexpected healthcare expenses. So therefore, as an example, HSA Bank has a $1,000 threshold limit. So once you get to that threshold, then you can start investing. But we like folks to at least maintain some of their monies in the cash account in order to pay for expenses.
Is that because there's no real systems out there or administrators out there that will offer forced liquidation, right? Because it creates a liability. So they really request that the employee goes in there and liquidates fund, making it sometimes a delay of when those funds are available.
Yeah, that is a potential risk factor there. So if you don't have the monies in your cash account and it's all in investments, and then guess what? A trip to the ER or an unexpected surgery, guess what? You have to liquidate your investments, and the market could be in your favor or it could not. So I think that's another reason why it really makes sense to establish some sort of a threshold level.
Yeah, and I think what we're constantly talking about, right, and you guys hear us saying it a lot, is that education is important, right? So obviously one of the key results that we wanted to hit on is education, right? I think we all agree with these results, with the number one timing of HSA education being being primarily at open enrollment. But why don't we take a step kind of back, throw it over to you all, and have another poll question, right? We all know that time constraints and cost constraints, right? Last minute changes to plan design and business kind of affect how much we can all invest into education. But if those time constraints and costs were not an issue, how often would you provide education to employees? Only during open enrollment, quarterly in addition to open enrollment, or would you go as far as providing monthly after open enrollment?
All right, I'm going to go ahead and close the poll and show the results.
Awesome. Wow, look at this. Boy, 66%. Boy, you couldn't have timed that any better. I think, again, quarterly in addition to open enrollment, I think that's a really good call out. We've got a pretty sophisticated group on the phone because I think that's a great strategy. I think most folks identify, don't just do it at open enrollment. That's really when things begin. Continue to do it throughout the year. So I'm really happy to see that trend. Keep up with that. Good strategy, folks.
Yeah, and monthly is a little bit too much, right? You'll burn out the employees. They'll lose interest. So, one of what we've seen, right, in our employee engagement strategy, especially with working with consultants, if we can go to the next slide, is, together, right, this is a plan that really needs to be embraced by everyone involved. The employer, the administrator, consultant partners if they're involved, but also by your employees as well. So as mentioned, traditionally, we ramp up into open enrollment, we drop off. But what we're doing more than ever, and we're hearing the request from consultant partners as well as employers, is let's make this engagement cycle more consistent. Let's, if we could add one more click to the slide here. Let's make sure it always ramps up, right? And let's really, if we can go to the next slide, really optimize the value of the HSA. So the optimizing really begins with, let's invest in providing the right level of guidance, offering those decision support tools, whether it's calculators coupled with other items. But what that does, especially if we do it on a quarterly basis, is it creates reinforcement, right? And the more reinforcement you provide, the more confidence you build within that employee to make the right decisions at the end of the day.
That's a great closing statement, Luis. Yeah, absolutely. Again, I think we delivered the overarching message there. Again, enjoyed providing the results on these surveys. So, Marissa, let's see if there's any questions. I know we kind of asked ourselves a lot of questions, but are there any questions that maybe that came in through the chat that we should probably address as we come to a wrap?
There are some questions, but we are at time. So I do think, so for attendees, I will be sending your questions to our speakers because we do have to start wrapping up here. Their email addresses are on the screen as well. But as we're closing out, Rob, Luis, do you have any final statements?
No, again, I think we have a very sophisticated audience here. Thank you very much for participating in the polls. Those were great results, and we enjoyed providing you the survey results. And please go and take time to look at those survey results. And again, our information there if you want to have any follow-up questions.